Hi, I'm Jimmy. In this video, we're looking at the overall strength of the US economy. We're using different economic indicators to see how strong the US economy is today and ideally try to identify, should we invest now or should we wait for the stock market to fall even further? Now, before we jump in, I actually want to let you know about a website that we're in the middle of developing that ultimately the goal of this website is that we can value stocks quickly and easily. So we might look at a stock like Johnson & Johnson, where we're getting a fair value using a 7.5% required rate of return of $194 per share. Basically, what this website will do on the first version, we're going to have many versions where we're adding more and more features to help us value stocks and research companies quickly and easily. But basically, we're taking analyst estimates for free cash flow. This is how many analysts there are for projecting each number, and then calculating the fair value real quick. So if we look at a company like Apple, well, a company like Apple is currently, it's trading $154. We're getting the fair value at $151. This is getting mighty close to being undervalued and could be a great buy very soon. Look at a company like Visa. This is a company on my bucket list that is currently below my calculation of fair value, and it's a company that I'd be interested in considering buying. Or we might consider a company like Microsoft. This one quite isn't at the fair value calculation just yet, but it is one that I would love to buy. I just want to buy the stocks right. If we can buy stocks at a good price, we're far more likely to get less hurt when the stock market does pull back. That's the goal of being a value investor. So if you want to sign up for this website, the website should be done by the end of the second quarter of this year. And if you sign up today, we are locking in your price forever. So you come over, you sign up, and that price will be locked in forever. Now, if you're curious, I will leave a link in the description below as to how to sign up. That being said, let's jump into the first economic indicator. Now, this one's one of the most important, and that is the Consumer Price Index. This is the CPI. This is a measurement of inflation. Now, there are different ways to measure inflation, but this is the one that the Federal Reserve uses, so it's probably a good place for us to start. Now, the most recent inflation number came in at 7.9%. That's fairly high. In fact, if we go back to obviously 2002, but you can go all the way back to the 1980s, and this inflation level is still the highest it's been since the early 1980s, and this is a giant problem for the economy in general. So when we click over and we look at our scorecard, clearly the first point is going to the bears here because this is a real problem for the economy in general. Okay, now the next economic indicator that we have is another important one, probably the most important, and that is consumer confidence. So we can see that down here, consumer confidence is near its lowest level in the past 20 years. It hasn't been this low since the financial crisis, and again, it dipped down here in 2011. But this is a huge problem for the economy, just like inflation. In fact, inflation is probably helping to lower consumer confidence. But basically, the purpose of consumer confidence is how confident is the consumer with their finances? How sure they're going to keep their job? How sure are they that they can pay their bills? The lower this falls, the more likely it is that consumers stop spending. Well, the US economy is, broadly speaking, driven by the consumer spending. If the consumer gets nervous and doesn't spend, that has a tendency to slow down the economy. That's why when COVID happened a couple of years ago, when it first started happening and the government started issuing all sorts of stimulus checks to individuals, it was to try to keep people spending because the US economy is in real trouble if the average consumer doesn't spend. So when we go back to our scorecard here, well, I think it makes sense to add consumer confidence for the bears as well. This is a big one too, because like I said, if this stays low, that could be a real problem. Okay, our next economic indicator is more of a nuanced one, and that is the yield curve. So the yield curve, ultimately what we're after here, when we're looking at this is measuring the interest rates, short-term interest rates versus long-term interest rates. So we could see right now, the U.S. Treasury is paying 38 basis points, or about 1/3 of 1%, if you invest for 3 months. That's actually an annualized number, but it is the equivalent of 38 basis points. If you invest for 30 years, 2.28%. Now, the reason this is an important economic indicator is it's the shape of this that matters. So this upward sloping shape is exactly what we want to see. If I'm going to invest for a longer period of time, I expect to be paid a higher interest rate. But when the economy ends up in trouble, oftentimes what happens is investors jump in and buy longer term safe investments, government bonds. They buy these, they drive the yield. This is the yield. This is the dividend amount, essentially the interest payments that they're making, the interest rate that they're paying. Those numbers go lower. So the more buyers that come into that, the lower the yield goes because the price will go higher. If you pay a higher price for the same essentially interest payments, you end up with a lower yield. So historically, when these numbers, now we can jump to a historical chart real quick. One of the more popular yield curves to watch is the 2-year versus the 10-year. The 2-year is the orange bar, the orange line. The 10-year is the blue line. And we would expect for the 2-year to pay less interest. If you invest for 2 years, you'd expect to receive less interest than if you invested for 10 years. But look at the times where the two intersect. When the 2-year gets up to the same level, when the yield curve flattens or even inverts, that's the fear, is you don't want an inverted yield curve. When it inverts, these are some of the worst times in history. And these tend to precede recessions. So we can see 08, 09, the stock market really crashed, but we saw that in the yield curve leading up to it. 2018, 2019, 2020, well, especially around when COVID was first announced, but before the economy shut down, well, the yield curve started signaling, I believe it was in like January of 2020, when the yield curve first inverted. Again, that's a negative sign. We can see the most recent time period, well, the 2-year, although it's not inverted, is getting mighty close to inverting. So I do think it's something that we should be cautious of. But for now, when we go back to the shape of it, for now, the shape of the yield curve remains okay, which in my mind indicates, when we jump to our scorecard here, that the yield curve is likely still a positive point, since right now it has not inverted. Okay, now our next economic indicator is unemployment. So this is the unemployment rate going back to 2002. Obviously, we want the unemployment rate to be lower. Lower is better. Clearly, the economy does better when the unemployment rate is falling. Right now, the unemployment rate is sitting at about 3.8%, which is not too bad. It's not quite as low as the government would like it to be, but broadly speaking, we can see compared to history, the current unemployment rate is fairly good. So that is going to be a positive sign for the economy. So when we switch back to the scorecard here, well, unemployment has to go to the bulls, since unemployment does look like it's doing fairly well. If we would end up in a recession and people were starting to get laid off, obviously this number goes bad real fast. Now, along those same lines is actually wages. So the Atlanta Federal Reserve they track wages, overall wages for the economy, and this tracks the percentage change. I should probably have a percentage up here, but it tracks the percentage change from year to year. So what was the average annual increase in wages from one year to the next? We can see that wages have increased by, the most recent number I believe was 5.1%. So clearly this is a positive sign, and on its own, it's absolutely going to be a point for the bulls. But when we compare that to inflation, well, it doesn't look quite as rosy. So don't forget, inflation's almost at 8% right now. So even if we are in the average, let's call it, and we are getting call it a 5% increase, but the price of goods and services have gone up by 8%, well, our 5% increase isn't quite keeping up with what inflation is dragging down to the economy. So when we go back to our scorecard, well, now I think that it makes sense to give wages as a point for the bulls, since on its own, it is in fact a positive sign for the overall economy. We wouldn't want wages. Imagine wages were falling right now. Well, that would be an enormous problem. Wages are growing, so At face value, that's a positive sign. But I do think that inflation, in fact, consumer confidence as well, they should be more heavily weighted than wages. Okay, now let's shift over to our next economic indicator, and this one's housing. So this is housing starts. And basically what housing starts do is it measures the number of new homes being built. And in theory, the greater the number of new homes being built, the more robust the economy is. As people are buying new homes, as the population continues to grow, and people are buying new homes, and they move into those homes, they have to furnish those homes. Well, ideally, that is a good sign for the broader economy. There's a lot of business that is produced when new homes are sold. So, outside of this one sort of crazy time back when COVID happened, the overall trend of housing starts has been higher since the lows of the financial crisis back coming out of 2008, 2009, even into 2010 when it really started ramping up again. So back to our scorecard. Again, it looks like this point's going to go to the bulls. Okay, now I think it's important that we look at manufacturing. So manufacturing is obviously very important to the broader economy. And this is the ISM Manufacturing Economic Indicator. And the most important level here is 50. Anything above 50 implies growth in the manufacturing sector. Anything below 50 implies negative growth in the manufacturing sector. Right now, manufacturing, yes, it dropped big time back in 2020, which we would fully expect. And anybody who worked in a manufacturing job, anybody who worked in most jobs, probably saw what happened to the economy in general and how many things got shut down. But since then, it seems that the manufacturing sector is once again growing. So this is a good sign for the economy. And when we switch back to our scorecard, well, I think it makes sense to give this point to the bulls as well. Now, right now, we have 5 points for the bulls and 2 points for the bears, but that is by no means, I do not want to give the indication that, hey, this is 5-2, bulls win, bears lose, game over. I think that inflation is a huge problem and consumer confidence is potentially a huge problem. Okay, now our next economic indicator is one that we actually haven't looked at in a while, but I thought it would be interesting and it could help our overall analysis if we glance at it. And this is the Baltic Dry Index. So basically what this index does, this economic indicator does, is it measures the cost of shipping goods via ship, essentially. So we can see that back when COVID first happened, well, the cost of shipping goods dropped a huge amount. And that probably makes sense. We were not shipping as many goods. A lot of people were staying home. Economic activity drastically slowed. So overall, the cost of shipping goods was cheaper. But then as things started to ramp up again, well, prices began to rise, and that's a stronger sign for the broader economy. Well, we can see that recently things began to head lower. Now, they bottomed out about a month or two ago, and since then we have seen some recovery in the Baltic Dry Index. We've seen some recovery in the cost of shipping goods, but I'm not sure we can call this a positive sign. I'm not even sure it's fair to call it a negative sign. So when we slip back to our economic scorecard here, well, I actually gave this point as a neutral point. And I know that doesn't ultimately affect the score here, but I thought it was interesting for us to glance at and for us to keep in the back of our mind when we're considering what we might want to invest in. So this brings us to the question, do we invest now or wait for the stock market to crash? And there's two answers to that. First, if we're dollar cost averaging, I think it makes sense for us to just continue to do that. Keep dollar cost averaging. Dollar cost averaging is when we put a certain amount of money into our investments every week, every month, every quarter, every year, whatever it is, and we just keep investing. And in theory, the lower the stock market goes, the more you buy. The higher the stock market goes, the less you buy, assuming you're putting in the same amount of money every whatever the time period is. That I think makes sense no matter what. Don't waste any time trying to time the stock market. Beyond that, if we're trying to pick individual names, I actually think it makes a ton of sense to stick with good value opportunities. That is one of the reasons we're putting up the website. We're trying to build the website to do DCF calculations for us, because with the volatility in the stock market right now, there are so many different value investment opportunities, even in big stocks, big names that historically haven't been that undervalued now look like they might be, thanks to a 10, 15, 20% pullback. Well, identifying those stocks and investing in those when they're undervalued is way more profitable over the long run. So if you'd like to sign up for our website, again, we're locking in the price if you do. If you come over, you sign up for the website, we're locking in your price forever. I will leave a link right over here and right in the description below for how to sign up to that website. And thank you so much for sticking with me all the way to the end of the video. I really do appreciate it. Thank you, and I'll see you in the next video.